When you partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
Moving iron.
Hello and welcome to Moving Iron Podcast Markets with Shawn Hackett. Shawn is with Hackett Financial out of Boca Raton, Florida. He's nice enough to come on and talk about what's happening in the marketplace. So, Shawn, how you doing this morning?
I'm good.
A lot of stuff to talk about today, Shawn. It seems like to be a recurring theme since you've been on this show, Shawn. There's always a lot of stuff to talk about. But crop progress reports came out. No big surprise there. The crops improved. Everyone got some rain. Things look good. But I can tell you in my neck of the woods where I live at right now, it has been, mid 80s for the most part all summer long till about like this last half of last week. It kind of started, we kind of started getting 2 or 3 days of 90 plus, and then we get, back to the 80s. But this whole week has been 90 plus, and the humidity levels are higher than they've been in the past, and there's just a lot of moisture in there. So your last week of July going into August prediction of, hey, things are going to turn hot and dry, it's starting to happen. So I guess talk a little bit about what you saw there and some of your reaction to what came out of that crop progress report.
Just remember the crop progress report, for the most part, unless you're completely, in an isolation chamber, is old news. Everyone already knew that the weather was good. We're going to see better crop ratings. So it really doesn't matter. What matters is what's coming up. And the models keep getting drier and keep getting hotter. And everybody has been got lulled to sleep because for 2 months, the models have said hot's coming and they back out. Hot's coming and they back out. Hot's coming and they back out.
Yeah.
But this time, as we have highlighted, you have to know when the models are right and you have to know when the models are wrong. I believe the models are right this time. And the reason they're right this time is because the hot sea surface temperatures that have developed off the Atlantic coast, which had been super cold, that is a dramatic change in the fundamentals for U.S. summertime temperatures. It's a massive change, and I don't hear anybody talking about it. Nobody's talking about it. It's a massive change. It's just dramatic change, and that's why the heat's coming, and it's going to deliver, and the models are right, and it's not going to be backing off. It's not going to be cool. It's a completely different fundamental. So now the surprise is that the heat's it'll be hotter than they thought, or it's going to be more extended than they thought, or it's going to be more easterly than they thought. And you can have wet and hot, Casey, and it hurts yields. If it's super hot and wet, it still hurts yields. Temperature is the most important fundamental, in terms of crop yields. More important than actual moisture is high heat. So this is really a big change. And if we meet that high heat I'm not anticipating, Casey, I want to be very clear, I'm not anticipating May, June low precipitation levels that were some of the driest we'd seen in 50 to 100 years. I'm not anticipating that for August, but I think we're going to be below normal. And that's all you need with this kind of heat is below normal rainfall in the core grain belt with high heat, and you're going to do a world of hurt to soybeans. You're going to do a world of hurt to the spring wheat, which the Canadian prairies and northern plains, and you're still going to take bushels off corn. Everyone thinks the minute pollination is done, you can't hurt the corn crop. You can and you will hurt the corn crop in August, just not as much.
Right.
Grain fill is extremely important, and you can lose, 2 to 4 bushels per acre off the top if you have an unfavorable August, which, that's not the same like losing 10 or 15 bushels off the top, like we could have it if July had turned out drier. But at the same time, it's not trivial. So I think when you look at all of that, it's telling me, and it should be telling everyone out there, that a sizable tradable rally from late July into the mid-late August timeframe, I think, is a pretty likely outcome. And then the question becomes, how high, how long, and obviously exactly what happens with weather, Casey, as we go forward, is going to be determining that. But I kind of like the prospects for grains here. If you're in the business of buying bean meal, corn, canola meal, I mean, if you're in the business of buying these grains, I just think I might get myself some coverage here. If you're needing to, you're wanting to, I think this might be a good time to be looking at doing that.
Yeah. Okay. All right. So, and that's something else you talked about, crop inflation, prices and stuff like that last time, and what that meant and what that would look like. So you're everything's kind of coming together here, Shawn. So,
well, the dollar crashing to new lows is a huge fundamental shift to a currency inflation related commodity price mechanism from a deflationary rising strong dollar mechanism. I mean, we have turned a corner to where the US dollar devaluation is now underway. Right. We've talked about this all for the last 6 to 12 months. At the back half of 23, we are expecting to see this take place. And we really believe that the next like really important low point for the dollar is going to be in that 2024, 2026. But the hard down phase is from now into 24, early 25. And so, we haven't seen a currency inflation related move in commodities. We had a little bit of it in late 2020, Casey, before the dollar rallied. But you'd have to go back to the 2000s, the last time we had a currency-related, inflationary-related move. And the most important thing for everyone to understand, what's so powerful about this, you could have no change in the fundamentals and corn could go up 20%. Because 2 billion bushel carryout, if the dollar is devaluing, could mean 6.5. In a deflationary strong dollar, it could be 4.5. The same fundamental means a different U.S. price based upon the prism that you're looking through. And that, I think, so many people do not understand. They're always looking at, supply and demand and using that to try to determine price. And that's very valid, and you should do that. But you have to look at through the substrate of currency and understand that we don't need corn supplies to come down to have a big rally in corn if the dollar's in a devaluation cycle. Now, if those supplies come down, it just makes the upside that much more exciting, right? That much more impactful.
Yep.
But that's why we're saying is, if you're having in a tub and you got a bunch of boats and you fill up that tub with water, which is a weakening currency, all the ships are going to rise. Now some might rise a little faster than others based upon their height and weight and width and what the winds are doing, but it's a rising tide, and that's the reason why we think and believe in and expecting that the overall commodities would turn up in the back half of 2023. If you look at the Goldman Sachs Commodity Index, if you look at the BLS Cash Commodity Index, both have turned up after making a secondary low and are now turning up. All the, the classical technical indicators are turning up. I think we've begun an uptrend in overall commodities that will likely last at least into the first quarter of 24. Doesn't mean you won't have corrections along the way. Doesn't mean it's straight up. But I think we have turned the tide, no pun intended. And one now wants to be buying breaks instead of selling rallies, which has been the winning strategy for the last 18 months.
Yeah, that makes sense. All right, let's jump over and talk about pork for just a minute. Pork is the little engine that could. It's finally seen some light here in the tunnel, but still has that anvil hanging off of a string, and the Roadrunner's about ready to cut it here again, I'm sure, and smash the coyote in the head. So I guess when you're looking at the pork industry right now, what are your thoughts?
Well, understand that we got to a record differential between pork cutout price and beef cutout price. So at some point, someone has to say, looking at a budget, well, I just can't afford that. I really like beef, but but I want my family to have some meat. So here you go. Secondly, we had African swine fever in China, and they just don't need anything and haven't been buying anything. We're not as much as they could have been buying. And then we had the Supreme Court decision that that upheld the California hog humanitarian treatment laws that says if you don't treat hogs in the humanitarian way as they've defined it, they are not going to allow pork to come into the state of California. Then that just caused a crushing blow to the market, and we had the worst margins, I believe, in history for a while. Then the Supreme Court said, well, maybe we were a little too rash. Maybe we need everyone a little bit of time to adjust.
They jumped the gun there a little bit.
Yeah, maybe we, cold turkey, maybe it's just not. Yeah. So they delayed it till the end of the year. And of course, what would you do if you're a buyer? You would buy every bit of pork you can get your hands on while you're allowed to bring that into the state of California before they close the door again. So that's been largely the reason that the hog market and the pork cutout price has taken off, is that there's been a mad dash of buyers to, get themselves, buttoned up here so they can get through this, period where they can't bring that pork in until hopefully the industry figures out what the heck are we going to do here? How are we going to manage this dramatic loss of domestic demand? The real reason to own hogs, in our opinion, is the post-African swine fever demand from China. That's really the long-term reason. This short-term rally, all nice, and we'll take it, and it's helped the pork producer make, get themselves in a better financial position where the prices are right now. It's not a long-term driver. Eventually, that demand's going to get cut off, and we have to deal with what do we do with it. But the China demand would be more than offset that. And right now, I look at the hog price in China as the signal I'm looking for to determine whether they're done herd liquidating and they're ready to see the hog price take off, give the hog producer in China a reason to rebuild the herd. If you rebuild the herd, you need a whole bunch of meal and corn and everything else. And it's not happened yet. In fact, we made new lows this week in the China hog price if you look at the September contract. So that's not giving me the green light yet. I'm absolutely 100% confident we're going to see that price take off before we get to the fourth quarter, but it hasn't happened yet. And that's what gives me great reservation on this rally in hog prices that's stemming from a short-term Supreme Court decision, but it's not really being generated by a long-term change in Chinese demand. I kind of feel like we're set up for a big correction. Maybe not going back to where we were, Casey, but it's certainly, I think, a big correction as most of the buyers are going to get themselves to where they need to be, and they're going to back away. I'd be a little worried on hog prices heading into August, maybe early September. And if I'm sitting here as a hog producer wondering what should I be doing, I think I would be taking advantage of some of those price increases. When you were looking at a near-death experience a month or two ago, I might just book some of those prices right now. I think that's the right way to manage risk until the Chinese parabolic demand comes into the equation and gives you the really exciting reason to be bullish the hog industry and the hog price in 2024.
Hypothetical here, just get your crystal ball out and let's talk about something here. So Russia backs out of the grain corridor deal, and which I don't think that's any big surprise to anybody. I think everyone saw that coming. I don't think that's a big deal. Immediately Russia missile strikes, drone strikes, all that stuff to the port of Odessa, further hampered Ukraine's ability to move grain out of the Black Sea region. Moreover, they pretty much made it clear that any ships leaving out of that area that are not Russian are going to get, attacked. Basically, and they kind of read between the lines what you saw. Ukraine is the fourth largest producer of wheat in the world. Right now, they have roughly about a half of a normal crop in storage. One ship came in, I can't remember where it came in from, maybe Lebanon or something like that, and got 26,000 metric tons of grain. Basically, You'd need something like 700 more of those ships to get the same level of grain out of Ukraine, and it's just not going to happen. So whether Ukraine comes back next year or not, and this is all over, then go back and plant regular crop again, it's going to be years before they can get safely in and out. And there's going to be a number of insurance companies that are going to say, yes, let's go drive these ships through an area that was once mined and see what happens. I just don't think long term, could this be the last year for the foreseeable future that Ukraine has the ability to move grain out of their area?
I don't know how to predict the future of geopolitics, and things can always surprise. But at the end of the day, I believe that this shift in the geopolitics is going to cause Russia to back away from lowballing the cash wheat price, which is what they've been doing for month after month after month after month, and that's what caused wheat prices to lose half their value, because they,
Right.
And I think, if you really think back on it, probably one of the reasons that they were willing to do that, number one, they had a record crop last year,
Sure.
winter wheat, 100 million metric tons, so they had a lot of wheat. At the same time, I think they were purposefully trying to put Ukraine production further out of business, knowing full well that once they did, then they could kind of name their price. Because at the end of the day, they need a lot of money to fund the war that seems to be going on forever now.
Mm-hmm.
And they don't. It's hard. They got to sell a lot of wheat at this low price. They can sell a lot less at a higher price and bring the same amount of money in, or sell the same amount of wheat and make more money. So I think if you really look at the chess pieces, probably their long-term strategy was to eventually cut Ukraine off from the rest of the world, and then they would back away. The price would take off, and then they would then come in, as a savior, providing wheat to those that are willing to buy it from them. Remember, their winter wheat crop's going to be 15% down, or about 85 million metric tons. Their spring wheat crop going to be down 10 to 15% from last year. So they're going to have a lot less wheat to sell. And if they have a lot less wheat to sell, they're going to need a higher price if they're going to generate the same amount of capital they generated last year when they had a lot more wheat to sell. So all this is bullish the wheat market going forward. And one of the reasons that I think grains are set up for a strong tradable rally here in August, and why I think overall commodities are turning up. Because I just think that this is a big shift, whether it's crude oil, which has had a big rally, whether it's even natural gas that's starting to rally. There's a lot of things, a lot of levers here from this Russia situation shifting that argues for we talked about currency premium coming into commodities as an inflationary. Geopolitical premium, which we have taken out, is likely to come back in to a lot of the commodity markets like they were 18 months ago. And so you put in geopolitical premium, you put in weather premium that we're talking about, you put in currency premium, you have yourself an uptrend in overall commodities, Casey. And typically when commodities turn either up or down, it's not 1 month, it's not 2 weeks. It's 9 to 12 months. Those are your typical up and down moves minimally in an overall market. Is in commodities, it's a multi-month move. So I think that's where we're at, and that's why any buyers out there that have been holding back, and they've been very successful, by the way, holding back. The buyers that have been living hand to mouth have made a killing living hand to mouth, but you also have to know when to shift and get in and go ahead and get some of your physical needs bought. We're at the point where you need to get things bought. I don't think hand to mouth is the right approach going forward, at least into the first quarter of 24. I think if you wait now and keep going hand to mouth, you're going to turn a very good strategy into a very catastrophic strategy in a hurry. And I don't think that is in anyone's best interest to do, especially if you're looking to manage your long-term business through your input costs. This is an awfully good time to lock those in right now.
Right on. All right, Shawn. Good stuff as usual. Folks want to reach out to you and get more information about what you're doing over at Hackett Financial. What's the best way to do that?
Our Twitter page is at Feridex. That's FERIDEX 11. We have a LinkedIn page. Of course, our website is Hackett, HACKETT, advisors.com. We're not habitual posters. We do save most of the information for our subscribers, but we do from time to time put on information and interviews about our work to give people an idea of what we do, to see if how we do things and why we do it is of value to your listeners.
Right on. Shawn, appreciate you being on the podcast.
Thanks, Casey. Always a blast.
We will talk to you again soon, my friend. All right, I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC. Go to LinkedIn at Moving Iron Podcast. Go over to the YouTube channel, which is Moving Iron Podcast. Check that out over there, and you'll see the video version of this podcast. Go to MovingIronLLC.com for everything Moving Iron related and all the information for the Moving Iron Summit coming up here in Nashville, Tennessee, September 11th through the 13th. If you want to sign up for that, you have roughly about 20 days to do that. So and it's almost booked up too. So if you're interested in doing that and you're making a decision, go ahead and hit the registration button there, and you'll get $50 off from the people over at Axon Tire. So with that, I'm Casey Seymour with Shawn Hackett. Let's go smart, folks. Out.
Moving iron in the 21st century.